Hello everyone, welcome to our video. In this video, we're going to talk about efficient market hypothesis. In this video, there are going to be four presenter. Me, my name is Goklas, and second one Aris, and then the next one is Ibu Anti, and then the last one is Dwiki. All of us will explain efficient market hypothesis, and we are the postgraduate student in IPMI. Okay, the first part, we'll talk about what is the definition, what is the meaning, and how do we understand the efficient market hypothesis. The second and the third part, we're going to talk about other theories that can be a critics to the first theories. And then on the last part, we're going to summarize and look into this strength and the weakness and how to use all of those theories in the analysis for stock market price. Thank you.
The basic wording of efficient market is very simple. It says prices reflect all available information. The question is how to determine whether prices reflect all available information, and we cannot do that without a model of market equilibrium. What Fama added to the story was just pointing out that we need a model of market equilibrium in order to carry out the test of market efficiency. In the early 60s, lots of people started working on stock market returns. And the question arose, what would if we expect markets were working properly? Random walk was the first manifestation of that. But it's kind of a clumsy statement because it doesn't recognize that we need a model of market equilibrium to decide what the market's trying to do in setting prices. So we can say that it is a joint hypothesis that says we cannot test market efficiency without a model of market equilibrium. It was started with a strong version of that hypothesis, that everybody has all relevant information. Tests of market efficiency are tests of some model of market equilibrium. Fama pointed that out, that it was clear that the random walk model was kind of irrelevant. We could have prices not following random walks because the model of market equilibrium could generate expected returns that had some predictable time-varying patterns on them. Prices could be random and still be inefficient. Basically, what market efficiency says is that the deviation of the realized price from the equilibrium expected value is unpredictable because, based on any past information, cannot be utilized. So the conclusion is, it is impossible to beat the market using any trading strategy. Theoretically, neither technical nor fundamental analysis can produce risk-adjusted excess return.
Hi, sounds great, right? Understanding the efficient market hypothesis, but some people might have a different opinion in regard to this efficient market hypothesis. It is true that the generations ago, the efficient market hypothesis was widely accepted by the academic financial economists. For example, Eugene Fama, 1970, influential surveys articles like efficient capital market. It was generally believed that the security market were extremely efficient in reflecting informations about individual stock and also about the stock of the market as a whole. This hypothesis has a challenge. The intellectual dominance of the efficient market revolutions has more been challenged by the economic who stress more on the psychology and the behaviors of the investor. The element of the stocks determined by the econometricians who argue that stock returns are to considerable extent and predictable. As long as the stock market exists, according to them, the collective judgment of investors will sometimes make mistakes. Undoubtedly, some market participants are demonstrably less than the rational itself. Moreover, the market cannot be perfectly efficient, and there would be no incentive for professionals to uncover the information to get so quickly reflected in the market price. This statement was point stressed by Grossman and Stiglitz, 1980. Another opinion in regard to the efficient market hypothesis comes from the analysis of investor behaviors, the behavior financials and the investor type, written by Michael Pompiani. According to Michael Pompiani, there are 4 types of investor, which are preservers, followers, individual, and accumulator. This type of investors might be not 100% believe on the efficient market hypothesis. For examples, the persons who really individual, typical types, they might more believe on their instincts instead of the market informations. Think about it.
In 1970, according to Eugene Fama, a market is said to be efficient with respect to an information set if the price fully reflects the information. While in 1980, Grossman and Stiglitz famously developed a paradox that shows it is impossible for a market to be perfectly informationally efficient. If competitive equilibrium is defined as a situation in which prices are such that all arbitrage profits are eliminated, is it possible that a competitive economy always been in equilibrium? Clearly not. For then, those who arbitrage make no private return from their private costly activity. Hence, the assumption that all markets, including that for information, are always in equilibrium and always perfectly arbitrage are inconsistent when arbitrage is costly. They propose a model in which there is an equilibrium degree or disequilibrium, which price reflect the information of this informed individual but only partially, so that those who expend resources to obtain information do receive compensation. How informative the price system is depend on the number of individuals who are informed, but number of individuals who are informed is itself an endogenous variable in the model. The model is the simplest one in which price perform a well-articulated role in conveying information from the informed to the uninformed. When informed individuals observe information that the return to a security is going to be high, the bid is priced up. And conversely, when they observe information that the return is going to be low, thus the price system makes publicly available the information obtained by informed individual to the uninformed. Let's put it this way. Either the efficient market hypothesis is true and therefore the financial market cannot achieve the rational expectation equilibrium, or a rational expectation equilibrium is achieved but therefore the market is not efficient.
Hi guys, this part is about summarizing that thing that we have discussed. And to summarize, I would like to raise two questions. The first one is, so which one do we believe? Which one as a group we believe? And then the second one, what should we do? So to answer the first one, we need to understand that every theory is an approach to understand a specific situation. So this theory is trying to explain what would happen in the specific situation. For example, the efficient market hypothesis must rely on the degree of the market efficiency. So there is a weak market efficiency, a situation where the semi-strong market efficiency, and also strong market efficiency. And this is also happening with what Grossman Stiglitz argue regarding the cost of arbitrage. So we need to understand that every market also have a different kind of cost for transaction or different cost of taxation. So this condition also reflect on the availability, on the chance to do the arbitrage. So in summary, I could say that to answer the first question, so which one is true? We believe that in certain situation, we could easily approach the understanding using a few theories. But I don't think that these theories is going to reflect all condition or in reality can represent all condition. That's the first one. The second one, what should we do? Should we just drop the technical analysis or the fundamental analysis and just follow the index? Or should we just do the random walk? Or should we just using reference or influenced by other people, like what behavioral economists thinking in regards to all the phenomena of the market prices? So I think what we should do is we need to understand what are we going to do. Is it a short term or is it a long term? And then we combine with the situation of the market, with the condition of the cost, condition of the efficiency, and also regarding on the background of the country, on the stock and everything. So we believe that if you are a long player in the stock market, you could actually follow the index and probably it will be easier. But if you are a very adventurous person, then you can also do a transaction in the short term and then using all of the knowledge you know to beat the market. That's all I think for the summary. Thank you.